Welcome to our channel. Today, we're going to debunk some of the most common investing myths that could be leading you astray. When it comes to investing, there's a lot of misinformation out there. It's easy to feel overwhelmed and intimidated, especially if you're new to the game, but I'm here to tell you that investing doesn't have to be complicated or scary. You don't need to be a millionaire to get started, and you don't need a PhD in finance either. We're gonna break down these myths one by one so you can start investing with confidence. Let's get started. Investing is only for the wealthy. This is a belief that has been perpetuated for years, creating a barrier for many who think they need a fortune to get started. How many times have you heard that one? It's a phrase that can discourage potential investors before they even begin. It's a common misconception, but it couldn't be further from the truth. The reality is, investing is accessible to almost everyone, regardless of their financial status. You don't need to be rolling in cash to start investing. Even if you have just a small amount of money, you can begin your investment journey. In fact, you can begin with surprisingly small amounts of money. The key is to start with what you have and build from there. Think about it this way, even with just an extra $50 a month, you can begin to make meaningful investments. Or $100 a month, you can begin investing in things like index funds or ETFs. These are great options for beginners because they offer diversification and lower risk. These investment vehicles allow you to buy fractional shares of companies, meaning you can own a piece of a company without needing to buy a whole share. So you don't need thousands of dollars to get started. This makes investing more accessible to everyone, regardless of their financial situation. Remember, the most important thing is to just start, even if it's with a small amount. Over time, your investments can grow, and you'll be glad you took that first step. The journey of investing is not about how much you start with, but about starting and staying consistent. Let's face it, the world of investing can seem like its own language sometimes. But don't let that scare you away. You don't need to be a financial whiz to start investing. There are tons of resources available to help you learn the ropes, from books and articles to podcasts and of course, YouTube videos like this one. One of the best ways to get started is to research different investment platforms and find one that aligns with your goals. Many platforms offer educational materials, beginner-friendly interfaces, and even robo-advisors that can help you build a diversified portfolio. Chapter 3, Myth 3, the stock market is too risky. Okay, let's address the elephant in the room: risk. The word itself can send shivers down the spine of even the most seasoned investors. It's the fear of losing hard-earned money that often keeps people away from the stock market. But is this fear justified? Or is it blown out of proportion? Yes, the stock market has its ups and downs, and yes, there's always the potential for losses. Market volatility is a reality that every investor must face. The sight of a red downward trend can be unsettling, and watching your investments dip can be nerve-wracking. But here's the thing, investing for the long haul is a different ballgame. When you look at the stock market over a long period, you'll notice a pattern of growth despite the short-term fluctuations. Historical data shows that the market tends to recover and grow over time. When you invest for the long term, you're not trying to time the market or make a quick buck. Instead, you're focusing on the bigger picture. You're allowing your investments to grow and compound over the years. This approach requires patience and discipline, but it can be incredibly rewarding. Instead, you're riding out those inevitable market fluctuations which smooths out your returns over time. Diversification is key here. By spreading your investments across various sectors and industries, you reduce the impact of any single investment's poor performance on your overall portfolio. By spreading your investments across different asset classes like stocks, you can tap into the growth potential of different markets. Stocks offer the potential for high returns, but they also come with higher risk. Bonds, on the other hand, provide more stability and regular income, while real estate can offer both income and appreciation. Each asset class has its own risk and return profile, and by combining them, you create a balanced portfolio. You're essentially not putting all your eggs in one basket. This helps mitigate risk and protects your portfolio from major losses. Diversification is like having a safety net. It doesn't eliminate risk, but it does spread it out. This helps mitigate risk and protects your portfolio from major losses. By understanding and managing risk, you can make informed decisions that align with your financial goals. So, while the stock market does come with risks, it's not as daunting as it may seem when approached with the right strategy. Chapter 4. Myth 4. You need a lot of money to start investing. Let's shatter this myth once and for all. You absolutely do not need a mountain of cash to begin your investing journey. Many people believe that investing is only for the wealthy, but that's simply not true. In fact, you can start investing with very little money and still see significant growth over time. The key is to start early and be consistent. Remember those index funds and ETFs we talked about earlier? These investment vehicles are designed to be accessible to everyone, regardless of how much money you have to start with. They allow you to pool your money with other investors to buy a diversified portfolio of stocks or bonds, which can help reduce risk and increase potential returns. They're your best friends when it comes to starting small. By investing in index funds and ETFs, you can gain exposure to a wide range of assets without needing to invest a large sum of money up front. This makes them an ideal choice for new investors who are just starting out. With fractional shares, you can invest in a diversified portfolio of stocks or bonds with just a few bucks. Fractional shares allow you to buy a portion of a share rather than needing to purchase a whole share. This means you can start investing in high-priced stocks like Amazon or Google with as little as $5 or $10. It's a great way to get your foot in the door and start building your investment portfolio. And the beauty of it is, as your income grows, you can gradually increase your investment amounts. Starting small doesn't mean you have to stay small. As you become more comfortable with investing and your financial situation improves, you can increase your contributions and watch your investments grow even more. Another great option is micro-investing apps. These apps are designed to make investing easy and accessible for everyone. They allow you to invest small amounts of money on a regular basis, which can add up over time. Some popular micro-investing apps include Acorns, Stash, and Robinhood. These platforms allow you to invest your spare change by rounding up your everyday purchases to the nearest dollar and investing the difference. For example, if you buy a coffee for $2.50, the app will round up to $3 and invest the extra 50 cents. It's a simple and painless way to start investing without even noticing. It's a painless and surprisingly effective way to start building your investment portfolio. By taking advantage of these tools and strategies, you can start investing with very little money and still achieve your financial goals. Remember, the most important thing is to start now and be consistent. Over time, your investments will grow and you'll be well on your way to financial success. Chapter 5. Myth 5. You should always follow market trends. Here's a hard truth. Trying to time the market is like trying to predict the weather 3 months in advance. It's incredibly difficult, if not impossible, to consistently buy low and sell high. In fact, many professional investors struggle to do this successfully. Instead of chasing trends, focus on what you can control, your investment strategy. Develop a plan that aligns with your financial goals, risk tolerance, and time horizon. A long-term, consistent approach to investing has historically yielded the best results. So tune out the noise, ignore the hype, and stick to your plan. Gap 3S. Chapter 7. Myth. You need to time the market. Many believe that timing the market is essential for successful investing. However, this is a myth. Consistently predicting market movements is nearly impossible, even for seasoned investors. Instead, focus on a long-term investment strategy and stick to it. This approach has been proven to yield better results over time. Remember, it's not about timing the market, but time in the market that counts. Chapter 8. Myth. You need to constantly monitor your investments. Another common myth is that you need to constantly watch your investments. While it's important to stay informed, obsessively checking your portfolio can lead to emotional decision-making. Set a regular schedule for reviewing your investments, such as quarterly or annually, and make adjustments as needed based on your long-term goals. This disciplined approach can help you maintain a clear perspective and avoid the pitfalls of impulsive reactions. Myth. Investing is only for the young. Some people think that investing is only for the young, but this isn't true. It's never too late to start investing. While starting early gives you the advantage of compounding, even those who start later in life can benefit from investing. The key is to develop a strategy that aligns with your financial goals and risk tolerance, regardless of your age. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more investing tips and insights. Remember, investing is a journey, not a sprint. Start small, stay informed, and stay consistent, and you'll be well on your way to building a brighter financial future. See you in the next video.